I'm very pleased to welcome back to the show Aaron Dunn, Keystone Financial. Aaron, you probably watched that interest rate announcement, of course, by the Bank of Canada on Wednesday, and it's kind of interesting, and we've got this cloud overhanging at least some of the yield market that says that we're certainly going to get another interest rate increase, but it's just not now. What was your take?
Well, it wasn't a surprise to us at all. We thought that they jumped the gun a little bit quickly with two increases back to back there. We're not as confident in the sustainability of the growth in the Canadian economy right now. But, you know, this is just really the same thing that we've been hearing for almost the past 10 years here. We're at such low interest rates even now that it's really easy for them to bump off of those lows with just any type of inflation expectations. So when that happens, then you'll get a lot of pundits coming up and saying that this time it's interest rates are going to continue to go up. We're going to start approaching historical averages again, and we've seen that cycle occur, you know, at least 3 times here over the past, I would say, 7 years, and it hasn't happened yet. So there's for us, we just focus on the strategy. We're not trying to predict if interest rates are going to continue to go up or where they're going to go, but we tend to believe that interest rates are going to remain low for an extended period of time. That's not a prediction, but it's just if you look at the economy nowadays, there's so much more debt in the market than there was in the past, say 20 years ago. Government debt, personal debt, and when that happens, it makes it really difficult for governments to start moving up interest rates. I mean, when they do it just a little bit, it really slams the brakes on economic growth a lot quicker than it did in the past. So that's not a prediction, but we focus on the strategy, and that's just recommending good, high quality companies at reasonable prices that are going to grow over the next several years here and generate value for investors. And part of that strategy, because people aren't getting yield from the bond markets like they used to, is to focus a lot on dividend growth stocks and companies that are paying a dividend. But they're also growing that dividend over time, and that's just the way. That's always been the way to invest, and we think that that's going to continue to be the way to invest in the future. You build up that portfolio, that base of solid, stable companies with attractive income and that are able to grow that income over time, and then you can further augment the portfolio. You can augment that return with some higher risk companies, some companies that are more growthy, and when you maintain that strategy, it's just something that's worked in the past, and we're very confident it's going to continue to work in the future.
When the prospect of higher rates, or when they do bump rates, does it impact the prices of investments that sort of are yield oriented? Because by comparatively speaking, like bond markets usually go down when interest rates bump up. What about in the preferred share market or the quality share market that pay good dividends?
Yeah, absolutely. So you're definitely going to see some impact to a lot of dividend stocks in the near term. There's going to be some near term volatility. We see that often as an opportunity, depending on the individual company. When you're looking at select companies that we like, that we think are going to continue to generate value long term, if they pull back temporarily because there's an expectation in the market that interest rates are going up, then we often see that as an opportunity. But yeah, you're going to see fluctuations in the market, absolutely. It's not so much it's not so much the Bank of Canada's decision or the Fed's decision. It just really comes down to what investor expectations are, what the feeling of the week is in terms of where bond yields and interest rates are going to be going. But even in an environment where rates are increasing, if you're focusing on companies that actually have a solid growth profile and are able to grow those dividends over time, then that's something that the bond markets can't replicate. I mean, with the bond markets, you basically get what you get for the most part. Your coupon payment, your interest payment, but it's not. Generally, it's for nearly all bonds. That's not something that's going to grow. So we see the dividend that a company generates. That's not the only reason to invest in that company. You're investing in the business because you think that it's a business that's going to generate value and continue to grow over time. And the dividend is really just one way that you're getting that value back out of the company.
Well, I want to come to something. You're going to be at the World Outlook Conference. Of course, Ryan Irvine, your partner, you guys are already working on the small cap portfolio to be announced at the World Outlook Conference. But I want to come to a company that you talked about last year, and it's a good news story, I'll tell you. Last year at the World Outlook Conference, you told us, and one of the things I like about Keystone's research is they put it in categories of risk, like this is a very low risk, this is an aggressive, this is mid-risk, that kind of thing. You told us it was a higher risk over-the-counter stock. It's Meritage Hospitality Group, but because you were coming on, I thought I better have a quick look at how it's done. It's up 70% since the last time you since you introduced it to the audience at the World Outlook Conference. By the way, in investment terms, Aaron, that's a good result.
Oh, it's a fantastic result.
Yeah.
Yeah. And we think that, I mean, it's the company's not done either. You're absolutely correct. We did talk about it as a higher risk company. I don't think necessarily that the underlying business is higher risk. What they do is they purchase Wendy's franchises, and they specifically find Wendy's restaurants where they can add value either by doing renovations, increasing sales through renovations and reimagings, but then also increasing margins by integrating these restaurants into their IT network and their supply chain network. So they've been incredibly successful at doing this. It's a very understandable business. They have a clear and understandable growth plan, which we love. They've actually done this before. In 2011, they implemented a 5-year growth plan to grow the number of restaurants from about 70 to 150, and that was a very successful growth plan. They generated triple-digit earnings per share growth. The share price over that period went up about 400%. And then just starting this year, once again, they've implemented a new 5-year plan to grow from about 200 restaurants to 420 restaurants over 5 years, and they're already well ahead of schedule on that. So, in terms of the actual business, we absolutely love this business, and just the fast food industry. I mean, it's understandable, and I can speak from my own personal experience. I've seen Wendy's restaurants here this company operates in the United States, but I've seen Wendy's restaurants around here that kind of look a little bit older that I felt that I didn't want to eat at, and then I've seen them reinvigorated, reimaged, and they just look like a completely new, modern restaurant. And I have eaten at them, and I love them. So this is a company that we continue to like going forward, Meritage, and the symbol is MHGU. Like you said, it does trade on the OTC over-the-counter, and that's one of the main reasons why we label this as a higher-risk company. It is smaller, about $120 million in market cap. It's thinly traded. Not a lot of shares out there because management owns 65%, and because it's OTC, you can't buy it in a registered account. But for investors that are looking to purchase a small cap growth stock, we think that this is good to have a reasonable sized position in this company, and we love the management team too. I mean, a lot of times when you're looking at these smaller companies where management owns so much, the worry is that the management is going to run it like it's a private business, but that has not at all been the case with Meritage. You know, these guys have done a great job communicating with investors, communicating with the market, and just driving shareholder value, and we think they're going to continue to do that.
I'm talking with Aaron Dunn, Keystone Financial, but you can find them at www.keystocks.com, www.keystocks.com. And I'll come back with you. And I got another couple of questions. Another one he's recommended at the World Outlook and on our show. It's done very well. I want to know, get an update for it, if he still likes it, or, not that he doesn't like the company, but he may not like the price and the value that the company represents. Plus, I'm going to play the lightning round. All of that coming your way, so stay with us on the Money Talks Network.
One thing I can tell you is you got to be free. Come together.
One of my favorite John Lennon Beatles songs, Come Together. It was a song, he wrote the song for Timothy Leary's campaign when Timothy Leary ran for governor of California against Ronald Reagan, which promptly ended, by the way, when Leary was sent to prison for possession of marijuana. Aaron Dunn's on the line with me right now. Go to www.keystocks.com, www.keystocks.com. Aaron, I don't think... I talked to your back office, so you probably don't know this, but this is a great time if you want to subscribe to the variety of the research products that Keystone Financial has, like their Canadian Small Cap Growth Stock, Canadian Income Stock Report, which I love, U.S. Growth Stock Report, the Canadian Small Cap Growth Report, and you can then combine it with the Income Report. There is some terrific Christmas deals on right now that we said a special Money Talks thing for December. So I'll get you to go to keystocks.com. It's right there. You can just click on it for Money Talks, keystocks.com. So just give a click on it and go from there. Aaron, we were talking just before something you recommended at the World Outlook Conference, Meritage Hospitality Groups. I want to go to another one, Algonquin Power and Utilities, another stock that you've recommended for Money Talks audience that I'd call a moderate, conservative kind of stock portfolio, but it's also done very solidly. And I just want to know what your perspective is going forward on this.
Yeah, Algonquin Power and Utilities. I've talked about it many times on the show, and I'm going to keep talking about it. We really like the stock still. We recommended it back in 2012. It was a little over $6 a share at the time, and since then the company is just pumping out dividends, pumping out dividend increases, and the share price has been moving up every year. So what I love about this company is that it combines the attractive attributes of a stable and somewhat boring utility business with those of an exciting growth stock. So they've been very focused every year on completing large acquisitions and building new power generation facilities, and all of this has been producing accretive growth in cash flow per share. So cash flow per share has been going up every year.
What kind of dividend are we talking there, or yield are we talking about?
So about 4.2% right now.
Okay.
And for your listeners as well, those dividends are paid in U.S. dollars as well.
AQN is the symbol on that one. Sorry, I'm flying all around, but I want to get to a couple of things because I'm going to play the lightning round with you coming up shortly. Another one that you've recommended that has done very well, you talked about it, I think in September, Diversified Royalty. The symbol's DIV, which is kind of an interesting company, first of all, but it's also up 20%, which makes it even more interesting to me.
Yeah, that's right. We recommended it in September. It's up a good amount already, but we still think that there's good long-term value in the company. What they do is they invest in royalties. They purchase royalties from recognizable brands. So right now they have royalties coming from Mr. Lube, from Air Miles, from Sutton Realty Group. It's a really nice yield, about 6.4%. They also have about $35 million in cash, which they have available to invest in a fourth royalty stream. The payout ratio is high right now. What happened is they had to sell an underperforming royalty about a year ago in some restaurants in Alberta, but they turned that around. They invested that money that they made into the Air Miles royalty, so that has improved the payout ratio, and then they have that cash there available to invest again. So we think that there's potential for very meaningful growth over the next 12 to 18 months. And it's also trading at an attractive valuation relative to other royalty companies right now. So looking a year out, we're thinking, probably about 14, 15 times free cash flow, which is the sector. Usually companies in that sector are trading at closer to 20 times. So this is a company, like you said, it has had a pop up recently. We wouldn't buy it for the next 1 or 2 quarters, but if you're looking to hold this for a couple of years, then we definitely see good potential for more share price appreciation. Of course, there's that dividend there, and we think that they will eventually grow the dividend as well once they reinvest that cash that they have.
That's Diversified Royalty. DIV is the symbol. Aaron, now it's time to play the lightning round. Are you all set with me?
Oh, I'm ready.
There we go. Lightning round with Aaron Dunn. Favorite movie?
Okay, this is tough, but since we're close to Christmas, I'm going to have to say Love Actually.
Best concert?
U2 and Black Eyed Peas at BC Place.
First stock win?
Sleep Country Canada, back when it was an income trust before it got taken private and came back to the public markets.
Favorite historical leader?
That is another tough one. I'm going to have to say JFK.
Best piece of financial advice you ever got or ever gave?
Well, both. I received it and I give it. Invest in yourself. Just invest in yourself, your education, your own knowledge, and everything stems from that.
Your favorite sport?
Between water polo and hockey, but I'll give it to hockey.
First job?
I was a dishwasher at Smitty's restaurant.
Best investment book you've ever read?
Easiest question of all, Intelligent Investor by Benjamin Graham. It completely opened my mind to value growth investing.
I turn on your iPod or maybe your radio in the car. What song is on?
Oh, these days you might hear something from Coldplay or Ed Sheeran, but, more than likely with my daughter being around my iPod, Twinkle, Twinkle, Little Star.
There you go. Favorite financial show on radio?
Well, I'm going to have to go with what all the kids think is cool these days, and that's Money Talks with Michael Campbell.
There you go, Aaron. Hey, Aaron, I look forward to seeing you at the World Outlook Conference. It's going to be great. The small cap portfolio, you'll be there. Ryan Irvine will be there. Get a chance for people to chat with you there. Look forward to it. But in the meantime, I hope you have a wonderful Christmas.
Thank you. Yeah, I'm really looking forward to the conference, and have a wonderful Christmas.
And just a reminder, people, go to www.keystocks.com, keystocks.com, and there's right there in the front page, you'll see it's a great time if you're thinking of subscribing, as obviously we have them on at the World Outlook, etc., because I think it's a very valuable service. What a cheap way of getting two first-class people to do your research for you. But go, it's the time to do it with the Christmas specials, so go to keystocks.com.